The focus of this short video is the Federal Reserve System. Now, as we've talked about in the past, the Federal Reserve is our nation's central bank, and the current edition of it was founded in 1914. Well, the actual law was passed in the end of 1913, but operation began in 1914. Now, prior to the Federal Reserve, we had two different central banks of the United States. We had the First National Bank of the United States, founded back in the early 1800s. Then you had the Second National Bank of the United States, founded in the middle 1800s, both of which were eventually killed by presidents who were opposed to the idea of a country having a central bank that was in charge of money. They felt that was a dangerous thing to have. But be that as it may, we do have a current system called the Federal Reserve, established again in 1914. Now, the Fed is organized as kind of a quasi-independent federal agency, kind of like the post office. The Fed is responsible for monetary policy in our country. One thing about them is they do not have to get Congress's permission to do anything. So as far as money policy goes, expanding, contracting the money supply, they give reports to Congress, but they don't have to seek permission from Congress. So that's an important distinction. The Fed is organized like most bureaucracies, a big pyramid. At the bottom, you've got the member banks. There's about 5,000 banks that belong to the Federal Reserve. Most of them are national banks. There are a few state banks involved. Being a member does give you some privileges as far as reports and Fed assistance, but it also entails extra regulation, so that can be a downside. The member banks do buy stock in their local Federal Reserve Bank, and that stock does pay dividends. However, they don't get to vote on anything. Now, as far as those member banks go, it's national banks and state banks. National banks have to join the Fed, so there's no choice there. And then state banks can join the Fed. How do you know you belong to a national bank? Because it has the word national in its title or the letters NA after its title. National banks tend to be older and larger than state banks, but national charters are harder to get, so that's the downside. Then you have the actual parts of the Fed, the Federal Reserve banks themselves. The United States is divided into 12 districts. Each has its own Federal Reserve Bank. Oklahoma is in the 10th district, and our Federal Reserve Bank is in Kansas City. Then there are also 25 branch banks scattered around the country, and our closest branch bank is in Oklahoma City. Again, these are the actual operating arms of the Fed. They're the ones working with banks on various things, handling money, doing check clearing, and sundry services like that. All Federal Reserve banks are operating in the public interest, and any profits they make goes back to the U.S. Treasury. Okay, moving up then, you're into the actual governance of the Fed. At the top of the food chain is the Board of Governors. This is the group that runs the Fed. There are 7 Board of Governors. They serve one 14-year term. The chairman is on a renewable 4-year term appointed by the president. He's one of the 7, he or she. They cannot be reappointed. They must be nominated by the president, confirmed by the Senate, so it's a very prestigious post. The most important committee in the Fed, and the one that you see the most press about, is called the Federal Open Market Committee. That's the 7 Board of Governors plus 5 of the Federal Reserve Bank presidents, one of which is always the president of the New York City Federal Reserve Bank. And that's the group that meets to settle open market operations, which is the buying and selling of assets. So securities, mortgages, whatever the Fed is trying to do to daily influence the money supply, that's being done to the Open Market Committee. Things the Fed does in general, number one is managing the money supply. And the key on this is the Fed doesn't really set interest rates in the United States. So they don't tell the banks what mortgage rates to charge. They don't tell the banks what rate to charge you on a car loan. They manipulate interest rates indirectly by managing the money supply. The only rates they really set directly are their own rates, the discount rate, which is what they charge banks when banks borrow from them, and they also set the federal funds rate, which is the rate that banks pay each other when they borrow reserves. So that's the only two they set. They don't set anything else in the country. They also serve as the government's banker, the fiscal agent for the Treasury. They distribute currency. They don't print it, they just distribute it. They do a check clearing service, which of course is shrinking over the years as checks kind of go away. They hold bank reserves. Recall we said that banks always have to have required reserves on hand, part of which can be deposits to the Fed. They supervise member banks, and then, as mentioned earlier, they are the lender of the last resort. So they will loan reserves to banks who are in trouble, but obviously banks don't like to do that because that invites a nice audit. So they try to avoid that. Now the big thing the Fed does is manage the money supply. That is really the critical thing that they do. And they have 6 tools they can use to influence the money supply. The most powerful tool is changing that reserve ratio. Now remember, the reserve ratio is the percentage of checkable deposits that a bank must have on hand. If you increase that amount, that means banks have less excess reserves, so they can make fewer loans, which shrinks the money supply, therefore drives up interest rates. And then if the Fed lowers that, the opposite case. If they lower that reserve ratio, that means banks now have more excess reserves, which they can make more loans, expand the money supply, and lower interest rates. Very powerful, but rarely used. Second thing they can do is they can change that discount rate or federal funds rate. If they lower those, that sends the signal to banks, go ahead and loan more money. We'll cover you if you get in trouble. If they raise that, this is the opposite case. They're telling banks, now if you get in trouble, it's going to cost you big bucks, so you better be careful. Third, they can do the open market operations. Anytime the Fed buys something, they're expanding the money supply because they're giving you money. They're buying something from you, so they're giving you cash, giving you money in your bank account. So that's going to increase reserves, loans, money supply, etc. Anytime the Fed sells something, they're taking money from you and putting it in their vault, which contracts the money supply. So that means interest rates are going to go up. Lately, the last 4 years, the Fed has been expanding the money supply. So they've been buying a lot of securities and trying to pump the money supply up, keep interest rates low so as to encourage borrowing. So we'll see whether or not that causes inflation down the road. The 3 minor tools, they can manipulate foreign exchange rates through foreign exchange intervention. That happens every once in a while. They can change the margin requirements on stocks. In other words, how much money you have to have down in order to buy a stock versus cash versus credit. Or they can simply talk to banks and say, hey guys, we want you to make more loans, we want you to make fewer loans, etc. and so on. So those are the indirect things that the Fed can do. Well, it's kind of the highlight of the Fed, a very powerful agency, not in the news all that much, but they have a tremendous amount of impact on the economy.